Let me ask you something. When was the last time you felt like the adults were actually in charge? Not politicians, not central bankers, not the guy on CNBC in a suit that costs more than your rent. I mean actually in charge, like someone, somewhere, had a plan. Yeah, me neither. Because here's what's happening right now. And I'm not saying this to scare you. I'm saying this because the data is screaming and most people have their headphones in. We are living through the simultaneous collision of 4 economic earthquakes. And the wild part? Each one alone would be a crisis. Together, nobody has a playbook for this. So today, no fluff, no filler, we're going to break down exactly what's happening, why it matters to your wallet specifically, and what the smartest money in the world is quietly doing about it. Buckle up. This one's different. The setup. The 4 earthquakes. Okay, imagine you're a structural engineer, and someone tells you, hey, there's a small crack in the foundation. You fix it. No big deal. But then they say, oh, also, there's a crack on the east wall. Okay, still manageable. And the roof is leaking. And the guy who owns the building just fired the inspector. That's when you start sweating. That's the global economy right now. Earthquake number 1. The dollar is being quietly dethroned. Not dramatically, not overnight, but like a king who keeps losing provinces. Slowly, then suddenly. The BRICS nations, Brazil, Russia, India, China, South Africa, and now a dozen more, processed over $1 trillion in non-dollar trade last year. That's not a protest, that's a structural shift. Earthquake number 2. The oil map has been redrawn. The U.S. became a net oil exporter for the first time in 75 years. That sounds like good news, and in some ways it is, but it also means America's incentive to protect Middle Eastern oil routes has fundamentally changed. The Strait of Hormuz, the narrow choke point through which 20% of the world's oil flows, is now someone else's problem, except nobody told the world that yet. Earthquake number 3. Debt has reached a point of no return. The U.S. national debt just crossed $36 trillion. The interest payments alone, just the interest, now exceed the entire U.S. defense budget. Think about that. America is spending more money on its credit card bill than on its military, and the credit rate just went up. Earthquake number 4. AI is destroying jobs faster than new ones are being created. Not in a sci-fi way, in a very boring spreadsheet way. White-collar jobs, accounting, legal research, customer service, mid-level management are being automated at a pace that labor markets have never seen. And the tax base that funds everything, it's built on those jobs. 4 cracks, 1 building, and the inspector just got fired. The dollar story, the slow divorce. Here's an analogy that'll stick with you. The US dollar is like the most popular kid in school. For 80 years, everyone wanted to sit at its lunch table. You needed dollars to buy oil. You needed dollars to trade internationally. You needed dollars to feel safe. That was the deal made at Bretton Woods in 1944, after World War II, when America was the only economy left standing with its factories intact. The world said, fine, your currency, our problem. And for decades, it worked beautifully. But here's what's changed. Trust is eroding. Not because the dollar is weak, it's actually strong right now, which is its own problem, but because countries are tired of being financially sanctioned the moment they disagree with Washington. Russia got cut off from SWIFT in 2022. Iran has been locked out for years. Now even allies are quietly asking, what if it's us next? So they're building escape routes. Saudi Arabia is now accepting yuan for oil. India is settling trade in rupees. Brazil and China are bypassing the dollar entirely in bilateral deals. This isn't a revolution, it's a slow divorce. And like most divorces, by the time it's official, everyone saw it coming, except the person it's happening to. The person it's happening to? Anyone holding savings in a currency that doesn't adapt.
Let's continue with the oil trap, The choke point nobody owns anymore. The Strait of Hormuz, 21 miles wide, 1/5 of global oil supply, every single day. For 50 years, the U.S. Navy was its security guard, not out of charity, because America needed that oil. But America doesn't need it anymore. It produces its own. So who's guarding the straw now? Nobody's quite sure. China needs it desperately. About 40% of its oil imports flow through Hormuz, but China has no real naval presence there. Europe needs it too, but Europe is busy, and the United States is openly debating whether it even wants to be the world's policeman anymore. Meanwhile, Iran, sitting right on that edge, is watching very carefully. One miscalculation, one tanker incident, oil hits $150. Inflation comes roaring back. Rates rise. Mortgages, groceries, insurance, everything costs more. And the recovery everyone's celebrating? Gone. This isn't a prediction, it's a pressure cooker, and the valve is already hissing. Now let's talk about the debt bomb, the credit card we can't cut up. Here's the simple version. You earn $50,000 a year. You're carrying $200,000 in credit card debt. Your minimum payment is now higher than what you spend on food, utilities, and your car combined. You're not broke yet, but you have zero room for error. That's the U.S. government. $4.9 trillion in revenue, $6.7 trillion spent, $1.8 trillion borrowed. And the interest alone? $1.1 trillion in 2024, more than Medicare, more than the military. When you're drowning in debt, you only have three options. You can cut spending, politically impossible. You can raise taxes, politically toxic. Or you can inflate it away, quiet, gradual, done before most people notice. Option 3 always wins. The inflation of the 1970s wasn't just about oil. It was about a government that overspent and chose inflation over accountability. History doesn't repeat, but it does send the same email with a different subject line. Now for the wild card, AI, the invisible layoff. AI isn't coming for your job like the Terminator. It's coming in a quiet, HR-approved cost optimization kind of way. McKinsey estimates 12 million Americans will switch jobs by 2030. Goldman Sachs says 300 million roles globally are exposed. Here's the twist almost nobody connects. Those jobs pay taxes, they fund Social Security, they support local businesses. When the paralegal, the junior accountant, the mid-level analyst get replaced by software, the tax base doesn't collapse overnight. It quietly hollows out. Less revenue, more debt, harder to dig out, and that creates a feedback loop. Less tax revenue leads to more borrowing. More borrowing feeds inflation. Inflation drives higher rates. Higher rates slow growth. Slower growth means even less tax revenue. Round and round it goes. So what is smart money doing? While retail investors panic or tune out, institutional money is making very specific, very quiet moves. First, hard assets. Gold is at an all-time high, not because it's exciting, it's a shiny rock, but because central banks bought more gold in 2023 and 2024 than at any point since 1967. When paper comes under pressure, people run to things that can't be printed. Second, energy infrastructure, not oil stocks, pipelines, LNG terminals. In a fragmented world, whoever controls the movement of energy controls the toll roads of the 21st century. Third, geographic diversification. The smartest portfolios aren't 100% U.S. denominated anymore, not because America is failing, but because concentration risk in a multipolar world is a bet you don't need to make. None of this is financial advice, it's pattern recognition, and pattern recognition is free. Here's the real emergency update. The world isn't ending. Don't panic, sell everything. The real emergency is complacency. Every major disruption in history, 1929, the 70s stagflation, 2008, came after warning signs that were visible, data that was public, and millions of people choosing not to look.
Not because they were stupid, because looking is uncomfortable. The people who came out ahead weren't the ones who predicted the exact crash date. They were the ones who understood the direction of travel and positioned themselves accordingly. The earthquakes are happening. The cracks are visible. The question isn't whether the building will shake. The question is, where are you standing when it does? Share this with one person who needs to hear it, not to scare them, to prepare them. That's the difference between a crisis and an opportunity. It's just information. And now you have it.